Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Report, coming to you once again with a value view of the world and the markets. As I sit here, somebody that watched one of my videos this week said, Tim, how come you don't dress up to do these videos? Why don't you throw on a coat and a tie and just look really professional? Well, I really don't wear coats and ties. I don't dress up that much. I run my operation from home. And to be honest, I shoot these videos usually on Saturday or Sunday early in the day. For instance, today is Sunday. And at that time, you're far more likely to find me in one of my vast collection of tropical shirts, or as I am today, wearing something from my rather extensive selection of grumpy t-shirts that the wife and kids seem to think that I need to own at all times. So hope you don't mind. I'm just going to talk dressed as I am and not play the little coat and tie and try to look professional game. This whole art of value investing is about finding a style that fits your personality. This happens to be mine. I'm a pretty relaxed guy, especially on the weekends. Anyway, it's another week, another higher market, regardless of what's going on out there. We're up about a little over 1% in the S&P 500 over the last week, and the all-world URTH index is up about 0.8% in spite of a complex situation in the Ukraine. Nobody really quite knows how that one's going to play out. Lots of noise from both sides. The West is in a very weak position because of that natural gas pipeline. I think we're going to see additional volatility in European markets in the weeks ahead because of the Ukrainian situation. Anyway, the big speculation in the financial press this weekend has been, when is the NASDAQ going to hit the magic 5,000 level that we have not seen in quite some time? The index is at 4336, and a lot of the policy and pundit wags this morning are out saying, hey, it's not that overvalued. It's only 21 times predicted earnings, so it's really got some upside left, and we're probably going to see 5,000 sooner rather than later. I have no idea if that's the case or not. The focus on zero interest rate policy to the exclusion of everything else could indeed make that happen. But I do want to point out that if you look at what's leading this market higher, it's big cap biotech stocks. They started to roll a little bit last week. We saw some weakness. I have no idea how to value biotech stocks. Don't think anybody else without an MD behind their name is really very good at it either. There's a lot of froth in there. Now look at the social media stocks. These things have 1999 valuations, trading at multiples of sales, much less earnings that are in the stratosphere. Most of them have triple-digit PE ratios on trailing earnings, with the exception of Twitter, which has no trailing earnings and is trading at about 250 times the estimates for next year. So a lot more froth in the NASDAQ and the leading components of that index than I think most people want to admit. And I would be really careful about chasing some of these large cap NASDAQ stocks higher. When it does roll over, it's going to happen without warning. Bubbles are only known in the rearview mirror, so if there's one there or not, I couldn't tell you. But if it turns out to be one, it'll be very painful to own a lot of those leading high multiple stocks. Anyway, moving on to the economic news, we saw what I think will be our last round this week of blame the weather economic reports. Kind of a mixed bag. We're going to have to see real numbers going forward of economic progress, I'll call it. And strength is probably the wrong word here, because the weather's not going to be able to be blamed anymore. So we'll see over the next few weeks how these numbers start to come in and get a better picture of the economy. A lot of people took heart from the jobs report on Friday. It was not the disaster that December and January's was. Not being a disaster does not indicate economic strength, okay? The 175,000 jobs that were created is just okay. It's not strong enough to provide forward growth in the jobs market. It's, you need to be well over that 200,000 month. So we're still in that economic environment that I like to describe as better than it was, but still a long way from good. We're just kind of muddling along in the economy. We still have the enormous disconnect between what's happening on Main Street and what's happening on Wall Street. At some point, that resolves itself in one direction or the other. Wall Street comes down or Main Street gets a lot better real fast. Now, looking through the news this week, I noticed when I put together my reading lists that I send out on Saturday mornings, a lot of articles this week about the community bank sector. Just a lot of attention starting to come on that focus because there's some things going on there that are actually very important. Now, the Minneapolis Fed was out with a statement that was reported in the Minneapolis Star Tribune that community banks could be looking at a new normal of sorts. They used to be in good times, community bank was extraordinarily profitable. There was a lot to the old joke about, this being a 3-6-3 career. You borrowed money at 3, lent it on 6, you were on the golf course by 3 o'clock in the afternoon, and they earned huge returns. That's changing. We could be looking at a new normal that is, in fact, much lower profit levels. Couple reasons for that. The loan and mortgage markets have changed. They've changed for good. The standards are much, much stricter. We're not going to see the loose standards come back anytime soon. You have a lot of competition for loans right now, and the small banks are just having a hard time staying in the mix of all the aggressive lenders and the bigger banks that are on the scene. So that's a problem for them. The other problem, we've talked about this a lot, is the crushing regulatory environment these guys are facing right now. In the Lehigh Valley Business Journal this week, Dave Lobach, who's the president and CEO of Embassy Bank of Lehigh Valley, said that the regulations are bringing a lot of cost, increasing his overhead, and they just don't make sense. It does not make sense to take these intense regulations designed to keep big banks from blowing up the world and applying them to a 2 or 3 branch local bank across the United States. But that's what's happened, and it's driving their costs a lot higher. In the same article, Tim Arthen, hope I'm saying that right, the director of government relations for the Pennsylvania Association of Community Bankers, said these regulations are causing a lot of unintended consequences, and they're creating a lot more problems for the smaller banks than any problems they may have been designed to solve. Remember, a lot of these regulations just don't apply. These local neighborhood and community banks did not do the crazy stuff that the Wall Street and the really large regionals were doing that caused the problems. But they've got the same compliance issues. It's going to be a very difficult situation for them. In fact, in the Houston Business Journal this week, Steve Stevens of Amegy Bank, that's part of Zion Bank, says he sees more mergers this year, and it's driven almost entirely by Dodd-Frank. So the article cited a study by George Washington University that said 83% of the small banks are going to see an increase in compliance costs of 5% or more. Given the margins that banks are working on, that type of increase is simply unsustainable. It's not just hurting the bottom line, it's erasing the bottom line for a lot of these smaller banks. Now, the Charlotte Observer was they had a couple mergers in that region in the past couple of weeks. They pointed out that we've got this looming TARP deadline that is really going to force some banks to merge. When they issued the TARP preferred, a lot of it's been paid back, but some banks have not. At the 5th year anniversary of the preferred, the interest rate goes from 5% to 9%. That's a devastating jump for some of these smaller banks. Again, added on top of the regulatory costs, it's a problem. It's erasing all the profits, causing losses, making it difficult to run the bank. So there's only one thing to do here. Look for a larger merger partner that can pay off the preferred, pay back the government their money, or at least spread the 9% interest cost over a larger asset base. That's looming for a lot of banks. Okay, TARP is just about 5 years old. We're going to hit the anniversary. Those interest rates are going to jump. Profits are going to disappear. They are going to have to sell. Now, we take all this in context, okay? The smaller banks are literally, you are either going to be the strongest, most dominant bank in your marketplace, and we see that in small towns and cities all across the country, where there is a small local bank that just dominates the marketplace. Queenstown Bank in Queenstown, Maryland, where I used to live, comes to mind. They own the market. They don't need to merge. They're going to be the exception, however. Smaller banks are being forced to merge. They're going to be merged at higher than the current stock price. We're still finding a lot of these banks at 75, 80% of tangible book value. The current merger multiples are starting at about 1.25 times book value. They'll work up from here over the next several years as this wave goes through the industry. Now, we started Banking on Profits last July, okay? Since that point in time, we've already been involved in 3 mergers, and that's before the merger wave really has taken hold, and we've seen things like TARP Preferred forcing the pace to accelerate. We have 8 stocks in that portfolio, or nearly a third of the portfolio, that are already up over 30%, because I'm not the only one on the planet that has figured this out. In fact, there's some very strong and active bank activists like PL Capital, Joseph Stillwell's bank funds, Patriot, the group of hedge funds that focuses on financial services. They figured this stuff out, and they're starting to buy up these stocks. It's going to be huge. I call it the trade of the decade. The small bank sector is going to make us a lot of money, and it's probably the most boring way to get rich that you'll ever come across in your lifetime. If you're not focusing on it, you should be. Anyway, moving along, the market is continuing to go higher. If you look at things like the market cap to GDP ratio, the Tobin Q ratio, and even the value line median appreciation index, we're on what can only be called the high side of fair. I don't know if this will lead to a sell-off, a sideways market while Main Street and profits and economic conditions catch up to the level of stock prices. Either is possible. But it's getting harder to find value. One of the ways that I've developed over the years, and I don't want to say it's infallible because nothing is, but it works pretty doggone well, and that's to follow the private equity money, figure out where they're going, try to get in there about the same time that they do, and should work out real well for you over their time horizon. Not yours. If you're trading 3 to 6 months, this is worthless for you. But if you have that 3, 5, even 7-year time frame, buying assets when the PE industry and the distressed industry is just starting to get in there, it can lead to some outsized profits like we've seen in the last year in the shipping industry. So where is the money going right now? Well, Kohlberg, Kravis, and Roberts just announced a $2 billion oil and gas fund. That's to take advantage of the values they see in the North American oil and gas sector, particularly the shale fields. We've been talking about that for well over a year. We own some names in the area. We're probably going to add exposure because these stocks are, we have a glut of natural gas, and nobody's quite got their mix of oil and gas where the street wants it. These stocks are coming down. They're trading at 50 and 60% of tangible book value. They're outstanding buys long term, because natural gas is going to become a much larger part of the overall energy solution, particularly here in the United States, possibly even a developing export market for U.S. natural gas over the next decade. Could lead to huge profits getting in here alongside the big private equity guys right now. We're also continuing to see money flowing into the mining sector. And if you dig it out of the ground, whether it's iron ore, gold, silver, it doesn't matter. If that's your business, your stock's been cheap for much of the last year. It's still cheap. Private equity and distressed players have started to notice it. They're moving in, starting funds. We've talked about that over the last few weeks. You'll see some of these assets start to catch a bid now, I think. Healthcare is a great sector for private equity. Unfortunately, because it's also been a great sector for the stock market, it's kind of hard to find values in that sector right now, but I am watching it. I've got my eye on it. If we can find some assets at a great price, I would be really excited to be in the healthcare sector right now. We are continuing to see money move into shipping. The distressed money is getting in there just as actively as the private equity money. You're seeing firms like Apollo, Oaktree, Avenue Capital, Kohlberg, and of course Wilbur Ross have all been taking an active interest in the shipping sector. As the global economy just kind of grinds to a recovery over the next, say, 5 to 7 years, and the number of older ships continues to be scrapped, we get rid of some of the excess capacity in the industry, the financially viable shippers are going to see their stocks do very well. We own a couple of them. I'd love to see a pullback to add a few more. We just sold one at a 95% profit last week after Starbulk, of course, announced just absolutely blowout numbers, much better than anybody expected. Stock got way ahead of itself and traded above intrinsic value. There are still some near bargains in the space, and we hope we get a chance to capitalize on them. If we don't, we've already got 4 or 5. We'll do pretty well across the various portfolios. There's $1 trillion of cash held by private equity funds right now. This is a result of successful fundraising, strong funds that have just wound down and they're reinvesting the money. Of course, there's been an enormous amount of IPOs and cash outs in the last year as they take advantage of the very attractive asset pricing market. They've been selling stuff and raising cash. If you get in there in front of that $1 trillion wave in safe and cheap securities, they're buying in that sector is going to push up the asset values all the way across the board, and you'll be a major beneficiary. This is a great way to look for values. Figure out where private equity is going. Try to get there early. We're doing that in energy, financial services, and of course, mining right now. It's not a lot of bargains, but there's a few, and we're taking advantage of that. So anyway, not a busy week on the economic front. We have a Japan monetary policy announcement. We have a few more retail earnings coming out, but no huge announcements due this week. Unemployment claims, of course, as always on Thursday, sometimes attracts market attention. If you have business to do in the southern portion of the United States this week, I highly suggest that you get it done before Wednesday. Both the ACC and the SEC tournaments start, and huge parts of the South, folks, are just going to go into lockdown. You're not going to be able to find anybody. They're going to be watching basketball. It's the only time of the year I give two hoots about basketball. I'm not a great basketball fan, but I do like the tournaments. This year, I'm looking for Gonzaga and Wichita State to make really deep runs into the tournament, do very, very well. And I'm hoping that Billy Donovan and his team of four-year college athletes beat out all the little one and done teams around the country and bring home the trophy for the NCAA tournament, which starts not this week coming up, but the week after all of the conference tournaments. So I'll be paying attention. Most of the South will be on lockdown watching this thing. So get your business done down here very, very quickly. And let's have a great week. This is Tim Melvin of the Tim Melvin Deep Value Letter, and we will talk to you guys next week.